Okay, so just to recap, in case you took a little dinner break or something, we're doing A buys B, we buy the net assets, we have a short goodwill calculation. So the next thing they want us to do, we did the goodwill, check. Notice the questions won't always ask it, that you have to know your first calculation, and oh my gosh, you're going to hear me say this about 100 times in the next 6 weeks. First you calculate goodwill, okay? Then we'll complete the purchase entry and the balance sheet after purchase. Okay, let's do company A. Purchase entry and balance sheet after acquisition. So we're company A, then we'll do company B. So you got to divide this in about thirds to leave room. Okay, so we are company A. What are we giving away? Well, are we giving away cash? I'm just going to pretend I can hear you answering. Okay, cash, $95,000. And who did we pay? Paid company B, not the shareholders. Okay, what did we get for that? Well, we got some assets. Now, I see we have assets at 88, but we also have assets at 09. Which one do we put on our books? When we buy assets at arm's length, and there's nothing going on, we put it at fair value. So we have to put the assets at fair value. We learned that way back in 315. So we're going to put 109,000, and that's... Now, did we just buy the assets, or did we take control of the liabilities also? Well, we bought the net assets, so we've got to take control or responsibility of the liabilities. So we're going to credit liabilities, and again, should I use fair value or historical cost? Fair value, and that's 29,000. Now, did we get anything else? Yeah, we got goodwill. So goodwill is an asset, and we calculated at 15,000, and that's a calculation. Okay. One thing you want to check, okay? They throw a lot of stuff at you at this 400 level. This was done on January 1st, year 2, right? Acquisition. Sometimes in questions you will see this actually done on the acquisition date, so you'll see some of this incorporated here, okay? So you kind of have to ask yourself if they're asking you for an entry, okay? So watch for this. Has this entry already been done on A's balance? And the answer is no. The date on the balance sheet is December 31st, which is before acquisition. So again, you guys, I'm throwing in little pieces that will show up in different questions. Okay, you're not going to see this all the time. Sometimes it'll just look like this. So they throw a lot of stuff in. What I try and do is give you a really solid, basic background of consolidation as we go through. I try and throw in the weird things they might do and give you an example for that. But After that, it's just doing more and more questions to get used to what they're doing. Okay? Okay, so next thing, I want Company A's balance sheet after this. Company A's balance sheet, January 1st, year 2. Now, you will be very happy to know that this is about as detailed as the balance sheet has to get. So it says Company A's balance sheet end of January 1st. We're going to have assets over here, and then we're going to have our liabilities over here. Okay? And of course, retained earnings. Okay, so our assets. Now, you notice they just call assets. Later on, we'll get to specific cash, accounts receivable, all that stuff. Right now, they're just getting you the idea. So, how much do we have in assets? Well, what did we start with? We started with 300. And what did we just add? Plus 109. So, check on that. Did we give any away? Yeah, we credited cash, so that's going to be minus 95, and that's 314,000. And of course, they said to keep goodwill arrest from everything else, or arrest separate from everything else. So that's going to give us 15,000, and it's going to say total assets 329,000. If they had listed separate assets like cash, AR, inventory, whatever, you would list those each separately. Now, we have liabilities over here. How much did we start with liabilities? Well, looking on there, 120. And then we added on 29 is 149. Now, there's common shares and retained earnings. But don't forget to check this goodwill off from here. Now, what do we have for common shares? Well, it's just ours because we didn't buy their shares. So that's 100,000 and 80,000 for retained earnings. So they should balance, and they do. Total liabilities and equity. So, Company A purchased the net assets, the actual assets. They may not have come over to our store, warehouse, whatever it is, but they are ours. So they were transferred on the balance sheet to us. The liabilities, the assets, we recorded our goodwill and shelled out our cash. This is what our balance sheet looks like after it's done. Okay, so that's Company A buying B. What did we buy? Shares or net assets? We bought shares here, so just remember. I'm sorry, not shares. Oh my gosh. Net assets. Okay, now we have to do Company B, the sale entry and the balance sheet after acquisition. So, Company B, sale entry and balance sheet after acquisition. Okay, so pause it and do the sale entry for the balance or the Company B. I'm just going to keep going, but you can pause it, try it, because you know how to do this. Oh, welcome back. I'm so glad you all tried. I can just imagine you guys all smirking because you didn't. Okay, so Company B. What did Company B get? Well, they got cash, right? And we know it was 95,000. Now, what did they give away? Well, they gave away their assets. Now, should I be using book value or fair value here? When I sell something of mine, not inventory, I'm talking in general, a regular asset, what do I take it off my books at? Book value. So we've got to use 88,000. And we got rid of our liabilities, which is good. $300,000, I can't see far enough. Oh, no, the assets were 300,000. Losing my mind. And the liabilities were 120. Hang on. Oh my gosh, guys. Let's just pretend we go back in time and you do this. Just because it's pretty. It gives you a chance to color. Okay, see, you missed doing that since you were a kid. Probably you guys are better colorers than I am. So, we're going to take a step back because I don't know what I'm thinking. Let's do the Company B sale entry and balance sheet after acquisition. And I'm sorry to say that if you actually had me in class, I occasionally do this as well. So I'm leaving this in because in case any of you ever get me again, then you'll go, yes, she's just human. Look, I have to have fun. I don't have you guys to be in front of. I'm just going to do it. Okay, so Company B. Company B gets cash. You guys probably knew this all along and were questioning what the heck I was doing. What did they get rid of? Their assets. So looking at their little page, let's look here and go, hey, yeah, this is Company B, not this. I was looking at the wrong one. So, do we use the assets that are book value or fair value? Well, they're on our books, we're getting off, so it's going to be book value. So what I started with, should have just stuck with it. And then value. Then we cancel off our liabilities. So also looking at the balance sheet, which is Company B, we've got $30,000 of liabilities at book value. Okay, that doesn't balance. So what do we do when we sell assets and it doesn't balance like it usually doesn't? It's a gain or a loss. So if we add these up, this is bigger than this by 37,000, and therefore it is a gain on sale. Okay, now I'm going to do the balance sheet horizontally there because I want to leave a little space down here. So let's do Company B's balance sheet. Start with the assets. What did they start with? Well, they started with 88 at book value. We took away this 88. Oh, and that's it then. They have 0. Oh, they got cash, so we're going to add 95, which is 95,000. And that's our total assets. They gave us everything, all they have is some cash. Now the liabilities, they had 30, they got rid of 30, so they are down to 0. Now the common shares, have they changed? Nope. So those are the same. Okay, but if I add this up with the retained earnings, it doesn't equal 95. So under here, retained earnings, they started with 3. But that's not going to balance. 33 and 25 is less than 95. Is there anything that happened during the acquisition that needs to be closed into retained earnings? Yeah, the gain on sale has to be closed to retained earnings. So do increase or decrease? They add. So that works out to 70,000. So now it matches. Total liabilities and equity is 95,000. So notice Company B, they've gotten rid of all their assets and liabilities, except for the cash they got paid and their common shares and retained earnings. So they could go invest that 95,000 in whatever they wanted, in another company, in shares in a different company, anything like that. Or they could just divvy up the 95,000 amongst everybody and close the company down. Okay? So that would be B, who was the acquiree. After the balance sheet. Okay. Now we're going to do example 3. I'll put a new video on.